Hey everyone, welcome back to another dividend investing video. We finally started to see the market pull back a little bit after a strong start to the year 2024. Still, the S&P 500 and many stocks are soaring at all-time highs. Despite this, I see companies that I think look appealing right now as a value-minded dividend growth investor. And today I'm going to briefly cover three in particular that I'm personally putting my own money in here at the end of the month of February 2024. I'll show you exactly why I'm buying these companies. And I'm buying with the intention of holding for many, many years. I'm not suggesting all of these are cheap, but I think for long-term minded investors, they're solid businesses at reasonable valuations. Let me know down in the comments, please. What have you been buying in February? And with that, let's dive in. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. All right, the first company I'm buying up this month is SnapOn, ticker SNA. SnapOn is in the tool manufacturing business. They bring their products directly to their customers and are known and well respected for their quality and craftsmanship. Now, shares have dropped over 5% in the last month. The stock took quite a dive last week after showing a decline in U.S. tool sales in an otherwise solid earnings call where they beat on both revenue and earnings per share. I took this opportunity to increase my own position this week. Now, shares are up about 6% if we go back to 1 year ago. Right now, trading right around the midpoint between its 52-week high and low. And looking back at the last 10 years in terms of total return, SnapOn has returned 205%. And this is slightly underperforming the broader market, although a month ago it was slightly outperforming the S&P 500. And also remember, past performance does not guarantee what's going to happen in the future. But if we look at it as a dividend growth stock, I think it's been highly underrated, guys. We're talking about an 85-year track record of paying their dividend without a cut. 14 years of consecutive raises, as the dividend was maintained during that last recession. But over the last 5 years, we have an average annual dividend growth rate of 15%. I think this is a fair valued company. It's not expensive, not exactly cheap, but it's a high quality company, the type I want as a foundation in my portfolio. And a PE ratio of 14 is right in line with the 5-year historical norm. It's also a nice discount to the industrial sector as a whole. Likewise, in terms of dividend yield theory, things are pretty close to the 5-year norm. The dividend yield of 2.77% is 7% above the 5-year average of 2.6%, maybe slight discount. Payout ratios are sitting pretty at 39% of forward earnings, 38% of forward free cash flow. Nice to see these two are close to in line with each other. The earnings per share growth and free cash flow growth, this is quite fantastic. Looks like 2022 was a tough year, but a blip it would seem. Simply Safe Dividends give SnapOn a perfect safety score of 99. About as safe as good as it gets, really. The SnapOn dividend is paid on its quarterly schedule. It's $1.86 per share, paid in the months of March, June, September, and December for a total annual payout of $7.44 per share. If you have your shares by February 22nd to get the next dividend payment on March 11th. The revenue has been inching up over the last 10 years, trending in the right direction though, going from $3.49 billion in sales in 2014 last year to $5.11 billion. Solid growth. SnapOn has been doing share buybacks as well to reduce their shares outstanding. An 8.7% reduction in shares outstanding over the last 10 years, which is another way SnapOn has been returning value to us shareholders. Return on invested capital is looking terrific here at 20% over the last 12 months. They're very consistently coming in those low 20% over the last decade. Margins are looking solid. Operating margin is 26%. Free cash flow margin is 21%. This is a ridiculously profitable company, SnapOn. And it's doing this with less debt than cash on hand. Just another reason I've decided to make this one of the core foundational companies in the Dividend Growth Income Portfolio. The average analyst price target is $276.78 per share. It's about 3.5% upside from where shares trade today. So not a whole lot of upside projected, but that could make it a decent time to accumulate. And accumulating I am. The next stock I'm buying up in February, Lockheed Martin, ticker LMT. The Lockheed Martin Corporation is a security and aerospace company. It's one of the largest defense contractors in the world. Half of its annual sales are to the U.S. Department of Defense. They have contracts also with the U.S. Department of Energy and NASA. Now, shares have fallen 8.5% in the last month. The stock slid in late January on earnings due to declining revenue in Q4 of last year in some of their segment. Now, over the last year, LMT is down 12%. It's been greatly underperforming the broader market on the short term. But if you zoom out over the last 10 years and you look at the total return, the stock actually edges out the S&P 500 by about 6% and generally has been a stock that beats the market. Past performance does not guarantee future results. But Lockheed Martin has been another strong dividend growth stock. We got 21 years of consecutive dividend raises, 31 years without a dividend reduction. The 5-year average annual dividend growth rate is a respectable 8%. PE ratio right now is at 16.3, just a hair above the 5-year average of 15.8. By this metric, it looks to be at a reasonable, fair value. Shares are yielding 2.98%. This is 12% above the LMT 5-year average, which can be an indication of an undervalued stock. Payout ratios are right where we want them to be, 48% of forward earnings, 51% of forward free cash flow, looking perfectly fine from here. Free cash flow per share has grown from $9.54 per share in 2014. In the next 12 months, it's projected to be $24.70 per share. And this is how we get sustainable dividend growth. Now, Lockheed Martin has a Simply Safe dividend safety score of 84 from simplysafedividends.com. They rate it very safe, highly likely to face a dividend cut. Lockheed pays out on a quarterly schedule in the months of March, June, September, and December, paying $3.15 per share for a total annual payout of $12.60 per share. The next dividend date is coming up on February 29th, so have your shares by then to get paid on March 29th. Now, LMT has been growing its top line over the last decade. Granted, it's been mostly flat for the last couple years, but this last year revenue was $67.6 billion, while 10 years ago it was a hair under $40 billion. Now, outstanding shares have been reduced by 22% over the last 10 years. Really nice, going from 322 million shares outstanding in 2014. Today, there are 251 million shares outstanding. Just how we like to see it. Return on invested capital is fantastic as well. You have 36% ROIC. It's been consistently between the 30 and 50 range over the last 8 years. It's another sign of a healthy company with lots of profits. Free cash flow margins are respectable. Level of 9%. It's pretty consistent. There was one shaky year there in 2018, but that clearly was a blip. Now, LMT, they do hold about $18 billion in debt, with a net debt to EBITDA of 2.32 and a net debt to capital of 0.77. So it's looking good on the first, not so hot on the latter, but it's very typical for them and how they run their business. So nothing out of the ordinary for them. We have an average analyst price target, $482.96. That's more than 14% upside from where shares trade today. I like the sound of that. Global conflict is an unfortunate reality of our world, and there's companies like Lockheed Martin in business as a result of this. I don't see this changing any day soon, and given this, I keep a spot for LMT in my portfolio, and I'm adding to it right now as it's one of my few positions I'm still in the red on, and I would like to continue to take advantage of that. The next stock I'm buying up in February, we're talking about NextEra Energy, ticker NEE. And as the name implies, it's an energy company, specifically an electric utility based out of Florida. They provide electric services to more than 12 million residents on both the east and west coasts of Florida, a very fast-growing area of the country. Utility stocks have been hit really hard over 2023. The NextEra was a dog in the market. You hear that dog barking, my neighbor's dog. Even over the last month, shares of NEE have declined 6.2%. Although shares are not at the 52-week lows that we saw a few months ago, over the last year, shares have dropped nearly 25%, so it's still down a lot. My own position is down about 15%. I began accumulating it in late 2022, and I was really buying it in the middle of summer 2023. And it's the biggest loser in my portfolio, in that portfolio right now, but I am doubling down. Despite the poor performance over the last year, this is a utility that's been beating the market over the last decade until just recently. We have a 10-year total return of nearly 219%. NextEra Energy has been a dividend growth investor's dream, and we're talking about a utility. It's a dividend aristocrat with 28 consecutive years of growing its dividend, even growing throughout the last recession. Now, dividend growth has been stellar, double digits over the last year. The 5-year average annual dividend growth rate has been 11% per year. The latest dividend raise was announced on February 16th, that's the day I'm recording this, another 10% raise. Now, back in 2022, NextEra set guidance on its dividend growth, calling for 10% annual increases through 2024. Now, here we are in 2024, and that's what they've been doing. In today's announcement, NextEra extended this projection, this expectation through 2026, a couple more years. So we can expect at least 2 more years of double-digit dividend growth. Now, the time will come when NextEra begins growing by the high single digits, but that's not yet here. And when you look at its peers like Duke, Southern, Con Ed, they're all dividend stalwarts. You're probably going to get a little more yield and income from those guys, but NextEra has the dividend growth, and that's what I am after. Now, NextEra's PE ratio has dropped, and dropped over the last year with a forward PE of 16.8. It's a 40% discount to its 5-year average PE. That's crazy. The recent dividend raise brought the yield up to 3.61%. This is 68% above the 5-year average of 2.15%. By dividend yield theory, NextEra is ridiculously undervalued. Now, payout on the dividend is 55% of forward earnings, below 75% is our preference for utilities, leaving plenty of room for continued dividend growth. Now, when we look at utilities, we don't really look at free cash flow. It's not really meaningful. Even though NextEra has been consistently raising its dividend by double-digit rates, its payout ratio has not climbed above 61% in the last 10 years. And it's actually been trending downwards. In addition to solid payout ratios, check out this rise in earnings per share over the last 10 years. EPS has nearly tripled in that time frame. SimplySafeDividends.com gives NextEra a very safe dividend safety score of 90, making it unlikely to face a dividend cut. NextEra, just like the other two, is a quarterly payer. Also, in those popular March, June, September, December months, paying 51.5 cents per share for a total annual payout of $2.06. Have your shares by February 26th for that March 15th pay date. Revenue was $28.1 billion in 2023, and 10 years ago it was $17 billion. So we don't expect much revenue growth in the utility, but things are trending in the right direction with NextEra. NextEra does have a good bit of debt with a net debt to EBITDA of 4.67 and net debt to capital of 55%, but both of these are within an acceptable range, and it looks like things have gotten under control over the last year or so here. Now, the average analyst price target for NextEra, $70.61. It's about 24% upside from where shares trade today. And that would be nice as I've been building up my own position here. I'm down a good bit, so I'll continue to use this opportunity to average down in the meantime. Guys, this is the only utility I own in my dividend growth income portfolio. But if you'd like to see the other stocks in that public portfolio, just click on into this next video where I step through each position and give complete transparency on the performance of the fund here. And I'll have another update at the end of the month to cover all my purchases and dividends received in the month of February, and some more great content between now and then. So click into that right now. Thanks for sticking around, and until next time, my friends, keep investing.